Short payoffs and tax implications. Objectives. The objectives of this chapter are to dominate how short payoffs work, clearly distinguish the two short payoff types, and understand short payoff tax implications and solutions. Owners of over-encumbered properties in foreclosure face only three possible options: reinstatement, sooner or later bringing the loan current; foreclosure, losing the property to the creditors; and the third option, the short payoff. This is the subject of this chapter. Short payoffs. Definition. A short payoff is the transfer of title over a property for less than the value of the debt secured by it. Creditors release their interest in a property for less than what they are owed. The creditor is paid short of the full payoff of the debt. Thus, short payoff. The reasons creditors accept short payoffs are logical. The collateral is worth less than the debt. The creditor's equity position is compromised, and the result of the foreclosure sale will be worse for them. Types of short payoff. There are two types of short payoff: short sale and release of lien. Purchase money and non-purchase money. To clearly comprehend short payoffs, it is important to first understand the concepts of purchase money, non-purchase money, and deficiencies. Purchase money. Purchase money is money borrowed for paying all or a portion of the purchase cost of the primary residence. Purchase money is borrowed simultaneously with the purchase of the property. It can be secured in any position. Non-purchase money. Non-purchase money is any borrowed money secured by any real property which was not used for purchasing a primary residence. Non-purchase money can be secured in any position. Purchase money qualifications. What qualifies as purchase money is always clearly defined by each state's laws. In most states, the concept of purchase money applies only to a debtor's primary residence and the primary residence of dependents. Most states have dollar value limits on what can be considered purchase money. Some states consider certain narrowly defined refinances as purchase money. Purchase money scenarios. These scenarios illustrate the concept well. Money used to buy a primary residence. Money borrowed to lower the balance of existing purchase money loan. For example, I borrowed $20,000 to lower my original mortgage from $80,000 to $60,000. In most states, that is considered purchase money. Money used to purchase a dependent's primary residence. For example, I borrow money to purchase a home for my elderly and dependent mother in which to live. In most states, this is considered purchase money. Non-purchase money scenarios. Non-purchase money is anything that does not qualify as purchase money. Cash out second mortgage. The second mortgage that I took to pay off bills is non-purchase money. Most refinancing. If it does not lower the initial purchase money debt, it is typically non-purchase money. For example, I refinanced into a lower interest rate, but now I owe $90,000 instead of $80,000. In most states, this will not be considered purchase money. Home improvement loan. If I get a second mortgage to fix the roof or improve the kitchen, it is not purchase money. HELOC, home equity line of credit. Secondary residence financing. What I borrowed to buy my beach house is non-purchase money. Construction loan. In most states, until I actually move in, what I borrowed to build my new home is non-purchase money. Investment property financing. The loans on my apartment building are non-purchase money. Big dollar value primary residence purchase loan. I buy my primary residence with two loans. The second loan is for $1 million. In most states, this will not be considered purchase money. Purchase money and non-purchase money implications. The difference between what is considered purchase money and non-purchase money are great. These are the implications. All states provide at least some level of purchase money protection. Non-purchase money does not have protections. As you will see later, this significantly affects short payoff and foreclosure outcomes. Purchase money protections. Purchase money has protections that truly shield a homeowner. Purchase money is non-recourse, or at least partially protected in most states. This means that creditors cannot collect on foreclosure losses. Most states do not allow deficiency collection of purchase money debt, even with judicial foreclosure. This means that after foreclosure, the homeowner walks out debt-free. Because of this, creditors secured by purchase money have more to lose and are typically more cooperative because a short payoff is their only option. Non-purchase money exposures. Non-purchase money has no protections. The consequences of foreclosure are highly penalizing to the homeowners. In some states, creditors can collect on foreclosure losses even in non-judicial foreclosure cases. This is called deficiency. The debtor remains obligated to all debts no longer secured by the property. Foreclosure does not free the homeowner of debt. Although it can be very hard to collect, creditors have less to lose and more options. Non-purchase money debt can only be eliminated by short sale and bankruptcy. Because of this, non-purchase money defaults are the source of the best short payoff opportunities. This brings us to the subject of deficiencies. Deficiencies. Definition. A deficiency is the payment shortfall suffered by a foreclosing creditor when the proceeds of the foreclosure sale are insufficient to satisfy the debt secured by the property sold. A deficiency includes the entire remaining debt value, not just the principal. Typically, interest continues to accrue. Deficiencies are usually not immediately collectible. The concept of deficiency only applies to the foreclosing secured creditor. The concept of deficiency does not apply to unpaid or partially paid secured junior creditors. This brings us to the subject of sold-out juniors. Sold-out juniors. A sold-out junior is any unpaid or partially paid junior loan no longer secured by the property because of foreclosure. Unless it is purchase money, the debtor remains obligated to perform on the debt. The security interest on the property no longer exists. The obligation becomes unsecured debt. The promissory note is still legally binding. Sold-out juniors tend to be difficult to collect. Creditors typically claim uncollectible debt from insolvent or bankrupt debtors as a tax write-off from bad debt. Collectible debt promissory notes are typically sold at a high discount to note-buying collectors. Sold-out juniors are the source of the majority of short sale opportunities. Collections are difficult for the creditor and unpleasant to the debtor. Deficiency judgment. A deficiency judgment is a personal judgment against the debtor in favor of a creditor who suffered a deficiency. A deficiency judgment is what makes a deficiency collectible. Deficiency judgments are enforceable by law. This means that all collection actions, including wage garnishment and liens against personal and real property, are enabled. Judicial foreclosures typically have built-in deficiency provisions. With non-judicial foreclosures, deficiency judgments need to be obtained by separate court action. Non-judicial foreclosure does not invoke the use of the court. It is not easy for creditors to obtain deficiency judgments after foreclosing non-judicially. The only solutions to a deficiency judgment are debt payoff or bankruptcy. Most states have anti-deficiency laws for purchase money debt. California is one of them. Since court action is very expensive, this type of litigation tends to occur mostly with high dollar value debt, such as commercial and construction loans. This brings up the subject of non-recourse loans. Non-recourse loans. A non-recourse loan is one in which the debtor is not personally liable for any loss incurred by the creditor due to foreclosure. There is no deficiency judgment possibility. In a non-recourse loan, the creditor feels extremely confident about the value of the collateral. Non-recourse loans tend to be low loan-to-value commercial and new construction loans. All non-recourse loans must include specific language such as, "This note is without recourse," in the documents. By definition, purchase money debt is non-recourse because homeowners are no longer obligated to the debt after foreclosure. The concept of non-recourse loan tends to relate more to commercial and construction lending. Short payoff solutions. As you can see, non-purchase money debt problems do not end with foreclosure. In fact, they usually get worse and last for years. The only solutions to deficiency judgments and sold-out junior collections are debt payoff and bankruptcy. The only alternative to this is a short payoff. A short payoff provides a negotiated solution for both the creditor and debtor. The short payoff solution depends on the kind of debt secured by the property, purchase money or non-purchase money, collateral value, and the financial capacity of the debtor. Short payoffs. As mentioned earlier, there are two types of short payoffs: short sale and release of lien. This is extremely important. The difference between these types of short payoff is huge. It is crucial to clearly be able to distinguish between the types of short payoff. We can't emphasize enough that not knowing the difference will lead to great trouble. Short sale versus release of lien. Short sale definition. A short sale is a settlement in full for less than the total debt value. The remaining balance is forgiven. The homeowner no longer owes anything to the creditor. The homeowner's personal obligation to perform on the debt no longer exists. The creditor takes a loss. A short sale is debt relief. Release of lien definition. A release of lien is the removal only of a creditor's security interest in a property for less than the total debt value. Release of lien is also known as lien release. The remaining balance is not forgiven. The homeowner still owes the unpaid balance to the creditor. The homeowner's obligation to perform on debt continues. The creditor does not take a loss. A release of lien is not debt relief. Typically, creditors first attempt release of lien prior to short sale. Short payoff settlement. A short payoff settlement is an agreement between creditor and debtor delineating the final resolution of the debt secured by a property. It is presented to the debtor in the form of a settlement letter. Short payoff settlement letter. A short payoff settlement letter is a letter stating the short payoff settlement. This settlement letter is also known as demand letter, payoff demand, or other similar names. This document states the short payoff terms, serves as final escrow instructions, and includes an expiration date. Settlement letter critical issues. These are the most critical settlement letter issues. The short payoff terms must be clearly stated and easily understood. Some settlement letters are drafted purposely very loosely. This can lead to big problems. Request a new settlement letter if needed. A foreclosure attorney should review complicated, wordy letters full of legalese. The distinction between a short sale and a release of lien is in the settlement letter. Short sale proof. The hallmark of a short sale is a settlement letter clearly stating that the debt is settled in full for a specified amount. The debtor is rarely required to sign and return the short sale settlement letter. Release of lien proof. The hallmark of a release of lien is that the creditor states the fact that only the security on the property is released. It clearly outlines that the debt will no longer be secured by the property, but that the homeowner is still obligated to perform on the obligation. Typically, the creditor demands a specific lump sum as immediate partial debt payment. The balance of the debt is typically to be paid as per the original promissory note terms. Sometimes a new promissory note is drafted. Homeowners are always required to sign and return the release of lien settlement letter at closing. To better understand how short payoffs are presented, let's analyze the following settlement letters. Release of lien. This is a good release of lien settlement letter sample. The settlement agreement is clear. It reads, HFC agrees to release its deed of trust only. This indicates release of lien for the minimum amount of $30,000. This is the partial payment due at closing. Due at close of escrow. Our customer, seller, must acknowledge their agreement to the terms outlined in this letter by their signature at the bottom of this letter. They need to sign. This offer shall be valid through June 24, 2005. This is the expiration of the settlement offer. It continues by stating that the remaining principal balance is no longer secured by your home. This means that the obligation is now an unsecured debt. The homeowner is required to sign the statement. I acknowledge, by my signature below, that I have read this letter, understand it, and agree to its terms. The debtors are required to sign. Release of lien affidavit. It is a great idea to, separately, have the seller sign an affidavit of understanding, stating that they will remain owing a balance. This is a good example. Release of lien affidavit. I understand that after the sale, I will still owe a balance. It is even better if the seller hand-fills the statement. Short sale. This is a good short sale settlement letter sample. The settlement agreement is clear. It reads, beneficial agrees to accept as settlement in full. This means that the debt will be totally settled, short sale, for no less than $30,000. This offer shall be valid through June 30th. This is the settlement letter expiration date. Private creditor short sale. Private individuals secured by real property also take short sales. This is a good example of a private loan settlement letter. It was hand-drafted and clearly states, I agree to settle in full. The most important features of this settlement letter are that it has clear escrow instructions and is notarized. A title company accepted this document for closing. Short payoff outcomes. Because of debt relief, all homeowners in foreclosure prefer a short sale, but this is not always possible. For the most part, short payoff outcomes depend on the creditors. A creditor's basis for selecting either a release of lien, short sale, or foreclosure depends mostly on the likelihood of successfully collecting the debt. The present and expected future financial capacity of the debtor will be taken into account. The more difficult to collect, the more likely the creditor will approve a short sale. The easier to collect, the more likely the creditor will only approve a release of lien. These scenarios will better illustrate the reasoning. Short sale scenario. Chances are that an unemployed 70-year-old person who is in bankruptcy will never be able to pay the debt. It will be difficult to collect from this person. In this case, chances are that a creditor will either take a short sale or foreclose and claim a tax write-off for the debt. Release of lien scenario. Chances are that a 35-year-old doctor who is presently insolvent because of a nasty divorce will, as soon as the problems are over, be in a different situation. He has a bright future, will soon be solvent, and able to pay. He will be an easy collections target. In this case, chances are that the creditor will either arrange for a release of lien or foreclose and collect later. Most people in foreclosure fit somewhere in between these presented scenarios. Short sale motivations. If immune to collections, the property owner will most likely not care. A good example is the case of the hypothetical elderly person. Chances of collecting are nil. If exposed to collections and conscious about it, the property owner will be motivated. These individuals have a lot to lose. Motivated debtors always prefer short sales. Who would not like debt forgiveness? Short sales are not always possible for debtors with future paying capacity. These individuals are good collection targets. Release of lien benefits. Good collections targets have no way to walk out of a debt. With them, foreclosure leads to collections. Collections are conflictive situations. To avoid aggressive collectors is indeed a great benefit. A release of lien is an amiable solution. The main benefit of a release of lien is to be in a payment plan rather than in collections. It has lower negative impact on credit. In the case of the hypothetical young doctor, chances of collecting are high. The debtor has much to lose. A person such as the doctor is always much better off with a release of lien than a foreclosure. The young doctor will sooner or later have to pay anyway. The release of lien is basically a payment plan. The foreclosure will result in aggressive collections and even the embarrassment of wage garnishment. The higher the debtor's income, the harder the collectors will press. All this can highly affect an otherwise bright future. Settlement letter caveats. Settlement letters are legally binding documents. It is extremely important to read and understand their exact meaning. In their attempt to collect, creditors will sometimes use tricky, confusing language to later be able to compel a debtor to pay. Consult an attorney anytime a settlement letter is not absolutely clear. Some settlement letters carry a debt reaffirmation clause. This clause will make the debtor re-obligated to debt discharged by bankruptcy. Non-arm's length transactions. Arm's length transactions are transactions between independent and unrelated parties. Non-arm's length transactions are transactions between related, dependent, or associated parties. In principle, there is nothing wrong with non-arm's length transactions, but in the foreclosure and short sale business, they carry risks. In your short sale career, sooner or later, you will be proposed to be party to non-arm's length transactions. Analyze the situation prior to engaging in it. Risky non-arm's length transaction example. Shorting a creditor for the homeowner to sell the property to a brother so that the brother sells the property back to the homeowner is risky. With modern information systems, creditors effortlessly keep track of property ownership for years. This sample document illustrates well the risks of non-arm's length transactions. It reads, Short Sale Terms Acknowledgement. The borrowers, by signing below, understand that the investor reserves all deficiency rights, including but not limited to criminal prosecution. Is any transaction worth this risk? Should it later be determined that we or any third party made any misrepresentations, for example, arm's length transaction, in connection with the origination of this loan or the proposed short sale transaction? Short payoff tax implications. In life, there are only two certainties, death and taxes. The issue is debt forgiveness. Debt forgiveness. Debt forgiveness is the cancellation of debt by creditor intent or bankruptcy court decree. The debt is pardoned. The debtor is no longer obligated to the creditor. Short sales are debt forgiveness because the homeowner no longer owes. Release of liens are not debt forgiveness because the homeowner still owes. Foreclosure sale debt payment shortfalls claimed by the creditor as loss for tax write-off purposes are debt forgiveness. This is because the homeowner no longer owes. To understand how taxation works, it is important to know what is a taxable event. Taxable event. A taxable event is an occurrence that has tax consequences. Any quantifiable financial gain or betterment has tax consequences. Earned income is a taxable event because of financial gain. Debt forgiveness is a taxable event because of financial betterment. These are the short payoff tax implications. Release of lien tax consequences. Because a release of lien is not debt forgiveness, it is not a taxable event. However, since the debt is no longer secured by real estate, the interest is no longer tax deductible. One way to mitigate tax impact is to recollateralize the loan with another property. Another possibility is to pay the debt by getting a mortgage loan on another property. Short sale tax consequences. A short sale is debt forgiveness. Therefore, it is a taxable event. The creditor will report the short sale loss as cancellation of debt. For that, they will issue an IRS Form 1099-C, cancellation of debt. Short sale tax solutions. The best way to tackle tax problems resulting from short sale or foreclosure is to use the service of a foreclosure-savvy CPA or attorney. Because of so many variables, everybody is different. What is certain is that investors and owners of second homes have few tax protections. Homeowners have many safeguards regarding their primary residence. Generally speaking, a debtor is tax exempt if the real property sold was a primary residence and the debtor was at the moment insolvent. The IRS form used for this purpose is IRS 982. This form is downloadable from the IRS website. IRS Form 982, Reduction of Tax Attributes Due to Discharge of Indebtedness. Review. We started this chapter by defining short payoffs. Then we covered the difference between purchase money and non-purchase money. Deficiencies, sold-out juniors, and non-recourse loans were explained. That gave us the foundation to understand the difference between short sale and release of lien. We finished the chapter by understanding debt forgiveness and short payoff tax implications. Short sale timeline. Objectives. The objectives of this chapter are to use time effectively, have the right time expectations, and properly time short sale actions. Short sale timeline. Let's start with the benchmarks common to the foreclosure process in all states. This is the date of default, which is the day when the homeowner stops paying. This is the collections stage. The creditors are trying to get the homeowner to get current. Presently, the homeowner is in default, but not yet in foreclosure. The default information is not public record. With institutional creditors, the collection stage typically lasts 3 to 4 months. Private loans are a lot faster. Sometimes collections can last as long as a year. This is the date of the recording and mailing of the notice of default. Here is when the foreclosure process begins. Now the property is in pre-foreclosure or in foreclosure. The information is public record. The length of the pre-foreclosure stage is different in every state. This is the foreclosure sale date. Shortly before that is the last day to cure the default. After this moment, the creditor is no longer obligated to accept a reinstatement, but they usually do. The best time to connect with a homeowner is as soon as possible. It is even better if the relationship is established prior to the recording of the NOD. This is when most of the competition arrives. The best time to obtain the commitment from the homeowner is as soon as possible. This means signed documents. For an investor, the commitment is a purchase and sale agreement. For an agent, the commitment is a listing agreement. If there is a buyer, that is even better. As soon as possible, it is important to open an escrow if there is a buyer, or at least obtain an encumbrance report or a copy of the recorded documents. As soon as possible, it is important to connect with all the secured parties. This is everyone shown on the title report. This is when the negotiations start. At this point, the transaction enters into what will be called the short sale negotiations period. The length of these negotiations varies greatly. It can be fast, but with most banks, it can take a long time. That is why it is important to start as early as possible and be fast. Sooner or later, in the short sale negotiation, an established sales price is approved by all the parties. This will be reflected in the settlement letter. This is the creditor's offer to settle the debt. The settlement letter has the purchase price, is approved by all parties, and has an expiration date. All this is reflected in the HUD-1 settlement statement. The transaction will close based on this information. This leads the short sale into the closing period. It is important to negotiate and counteroffer to have as much time to close as possible. The more time to close, the better. The closing period ends the date of the settlement letter expiration date. For the purpose of education, we are going to call the period prior to the settlement letter the exit strategy development period. This is the moment to arrange how to get paid. This subject is covered in a later chapter. The key to this moment is to start creating as many options as possible. There needs to be plenty of fallback positions. This is when to start obtaining commitments and gauging options, not later. Exit strategies. Which exit strategy to use depends on a specific situation. Agent exit strategy development. Have offers with backups. Start getting the loans pre-approved. Investor exit strategy development. Have funding options with backups. Once the settlement is approved, the transaction needs to start closing. We are going to call the period after the settlement letter the exit strategy execution period. This is the time to close and get paid, not the time to start looking for buyers. Close with the most appropriate exit strategy. Have backups. It is very important to close as soon as possible. At the latest, the closing should be at least a few days prior to the expiration of the creditor's offer. Closing. A closing has 3 events: signing, recording, and funding. Signing is when the transaction parties arrive to an agreement and sign the documents. Recording is when the signed documents get recorded at the county or relevant jurisdiction. Funding is when the funds get distributed. This is when the creditors settling the debt on a short sale get paid. Closings are sequential. First, the parties agree and sign. Then the escrow service funds and records simultaneously. For practical purposes, creditors only care about funding. It is important to close early enough to record on time. It is not always possible to fund the same day as the signing day. Do not risk late funding. If the signing is too close to the settlement expiration date, the funding may arrive too late. Late funding will void the transaction. Time is of the essence. In short sale, time is not to be underestimated. If time is running out, negotiate an extension. It is better to have more time than to rush. It is not hard to obtain a 30-day extension. An extension is nothing more than a postponement of foreclosure sale. Postponement lengths vary. Ask for as much time as possible. Creditors postpone all the time. Windows of opportunity. As early as possible is the best window of opportunity. The earlier the better. More time means more chances of closing. The later the short sale starts, the lower the chance of success. The later, the worse. Many property owners wait until the last few weeks or days before taking action. That comes with the territory. Review. Short sales are time-driven transactions. Start as early as possible. Always do things ASAP. The more available time, the higher the success chance. Always ask for more time. Develop exit strategies during negotiation. Execute exit strategies ASAP. Ask for more time if needed. Listing Agent Timeline. Objectives. The objectives of this chapter are to use time effectively, have the right time expectations, and act based on listing agent short sale demands. Listing Agent Timeline. Initially, the property owners are current in payments. However, they know that very soon they will default. For practical purposes, we will say the client is in pre-default. This new line below represents the listing agent timeline. As soon as the property owner defaults, this person will enter into collections. This collections period lasts up to 120 days. At this point, the default is not yet public record. Collections are just between the creditor and the property owner. At this point, very few people know about the default. Once the creditor gives up collecting, a notice of default is recorded. At this point, the property owner is in pre-foreclosure. The recording of the notice of default makes the default public record. This is where most foreclosure lists are originated. Most marketing materials arrive to the client during this period. If default continues, eventually the foreclosure sale date will arrive. The best moment to obtain a listing is when the property owner is in pre-default. The beginning of this blue line is when the short sale action starts. In short sales, it is better to have a long listing, 1 year long if possible. If there is time, it is a good idea to list the property for 1 full month at a value that covers the full debt, plus commissions and closing costs. The aim of this is to give the property a full price listing history. This is a good moment to start contacting creditors, create a preliminary HUD-1, collect the short sale package, and, if the creditors are open to it, possibly begin short sale negotiations. At the least, everything should be ready to start a short sale as soon as there is an offer. If the property is over-mortgaged, no offers will be made the first month. After the first month is over, price adjustments should begin. This is when discounting the property begins. For short sale negotiations, always consider these factors. Ask for a 60-day closing. Expect long waits. And offers will fall off because buyers will get tired of waiting. Avoid showing multiple offers to the loss mitigator. Keep those offers as backups. Showing several offers to the loss mitigator will typically delay decision-making. Once the price is adjusted, a first offer will be accepted. This is the offer with which to start the short sale. Chances are that the first offer will fall off. A second offer will be accepted. Chances are that the second offer will also fall off. A third offer will be accepted. Sooner or later, the first settlement letter will arrive. It is a good idea to counteroffer for at least more time. If needed, counteroffer for lower price too. The settlement letter needs to be realistic. Very soon, there will be an acceptable settlement letter. A settlement letter with a 60 days closing is preferable. Time pressures make things difficult. If everything went well, the settlement letter expiration date should be well before the foreclosure date. It is important to close as soon as possible. Have a lot of time to close, but close in a short time. Sometimes there is not enough time to realistically close as per the settlement. If more time is needed, request an extension for closing. Obtaining a 30-day extension is usually not hard. If the creditor is flexible, there will be another closing date. For that to happen, the creditor will postpone the foreclosure. That means there will be another foreclosure sale date. If even more time is needed, request another extension. If the creditor is flexible, there will be another closing date. For that to happen, the creditor will postpone the foreclosure again. That means there will be another foreclosure sale date. Extend the listing agreement every time the sale is postponed. Review. Start the short sale as early as possible. List property for as long as possible. A year or more is better. If possible, initially list property at full payoff plus transaction costs. Make price adjustments as needed. Be ready for offers to fall off. Request long closing. Extend listing every time you get the foreclosure sale postponed. Bankruptcy. Objectives. The objectives of this chapter are to understand bankruptcy from the short sale's point of view, to identify issues before they become problems, to handle transactions by using the effects of bankruptcy to your favor, not by fighting against them. Bankruptcy is highly associated with foreclosure. It is extremely important to understand this subject. The issue is the stay. An automatic stay is an injunction against foreclosure or other collection efforts. An injunction is a court-ordered restriction. A stay restricts creditors from foreclosing. They can't foreclose. However, the property can't be sold either. For every action, there is a reaction. Relief from stay is a permission from the court to proceed with foreclosure or other debt collection efforts. Relief from stay allows creditors to proceed with foreclosure. Bankruptcy creates a tug of war. An owner wants to prevent or delay a foreclosure. A creditor needs to foreclose in order to collect debt. Bankruptcy. Definition. Bankruptcy is a proceeding under federal law to relieve a debtor from debt by discharge or restructuring. The debtor's property is transferred to a bankruptcy trustee or held by the debtor under the jurisdiction of the court. Types of bankruptcy. For most consumer debtors, there are two types of bankruptcy. Chapter 13 bankruptcy is reorganization of debt for individuals. Chapter 7 bankruptcy is the liquidation of assets and discharge of debt. Chapter 13 bankruptcy. In Chapter 13 bankruptcy, the debtor usually wants to protect assets. It triggers an automatic stay. However, the owner needs to keep up with the loan payments. Usually there is a forbearance agreement, and usually the property has some equity. If the property has equity and it is sold, the equity will be used to pay creditors. How many homeowners would like to have their home sold to pay creditors? None. Protection of equity is a good reason to be in Chapter 13. Chapter 7 bankruptcy. In Chapter 7 bankruptcy, the debtor has to surrender non-exempt assets. Usually the debtor is insolvent and the property has no non-exempt equity. The property is most often behind in payments. The creditor always requests relief from stay. The trustee, for lack of equity, abandons the property. The property is declared no asset. Unless things change rapidly, the owner can't keep the property. Sooner or later, the property will be either foreclosed or short-saled. The following are the main bankruptcy concepts you will encounter in short sales. Exempt assets. These are the type of assets that may be shielded from unsecured creditors. Asset exemption varies widely by state and county. Exempt assets are typically items that are needed for a person to survive. Examples of exempt assets are primary residence and vehicle, important work tools, life insurance, and retirement plans. Sometimes items in trust can be exempt. Non-exempt assets. Non-exempt assets are the type of assets that may not be shielded from unsecured creditors. These are basically everything that a debtor owns that is not specified as exempt by the law. These assets are given in trust to the bankruptcy trustee to liquidate. These items, if of enough value, will be sold off to fund debt payment. Good examples of this are a second home and a recreational boat. People can live without these items. No asset. No asset is any personal or real property with little or no recoverable monetary value. The bankruptcy trustee assesses the value of the asset. 95% of bankruptcies are no-asset bankruptcies, meaning there are no assets of value. The bankruptcy court or trustee abandons no assets. Some example no assets are a house without non-exempt equity, devalued personal belongings, TV, furniture, etc., 100% financed new vehicles. This vehicle is considered a liability. Chapter 7 Bankruptcy Discharge. Chapter 7 Bankruptcy Discharge is a court-ordered elimination of most of a debtor's obligations. Creditors can't attempt collections of discharged debt. It is prohibited. Not all debt can be discharged. These examples illustrate the concept. Credit card and personal loans tend to be dischargeable. Most taxes, student loans, fraud debt, and intentional injury debts are not dischargeable. The best way to understand the effects of bankruptcy and short sales is by using a bankruptcy timeline. We will focus on Chapter 7 because it is more relevant to short sales. Sooner or later, most Chapter 7 properties will have to be sold. Chapter 7 properties are commonly seen in short sales. We will not focus on Chapter 13 because most often the owner wants to keep the property. Chapter 13 can last up to 5 years. Thus, fewer transactions can be found in this category. Bankruptcy timeline. The vertical lines are events. The horizontal line is time. On the upper side is the homeowner. From the bankruptcy point of view, the homeowner is a debtor. On the lower side is the creditor. This entity is usually a bank or mortgage company. It can also be a private individual. The first case can be either a Chapter 7 or a Chapter 13. A bankruptcy starts with a commencement. This is a bankruptcy commencement form. This example shows a Chapter 13 commencement. This other example is for a Chapter 7. This is the type of bankruptcy most commonly seen in short sales. Somewhere on the first page it says, creditors may not take certain actions. The filing of the bankruptcy case automatically stays certain collection and other actions against the debtor and the debtor's property. Now the property is in a stay. It can't be foreclosed. At this point, the debtor is in bankruptcy and protected by the automatic stay. If it is Chapter 7, the process can take 5 months or more. The first thing the creditor will do is to file a motion for relief from stay. Motion for relief from stay. To collect, the creditor needs to get the property out of the stay. At this point, for the creditor, to collect means to have the ability to foreclose. This is a sample document. It says, Motion for Relief. For the motion to be granted, the reasons need to be stated. The document reads, Relief from stay should be granted because of failure to make payments, lack of insurance on collateral, and no equity. Notice to abandon. If the property has no equity, sooner or later the trustee will have to abandon the property. The property will no longer be protected by the bankruptcy. This is a sample notice of intent to abandon. It reads, Notice of intent to abandon. The trustee proposes to abandon the following estate property: the debtor's residence. The trustee believes that there is no equity for the estate in such property. Such property is of inconsequential value to the estate, because the residence is over-encumbered. If the property is evidently overmortgaged, the first motion for relief from stay will most likely be granted. Sooner or later, the case will be closed or dismissed. If the case is closed at the time the debtor is discharged, it is a no-asset case. Alternatively, the case can be voluntarily or involuntarily dismissed. Either way, there will no longer be a stay. If the case is voluntarily dismissed, the debtor can't file for bankruptcy for 6 months. Since there is now no stay, the creditor can foreclose. These are the most relevant Chapter 7 outcome documents. Chapter 7 Order of Discharge Letter. It reads, Chapter 7 Order Discharge. The debts shall be granted a discharge. It continues, collection of discharged debts prohibited. Voluntary Dismissal Letter. It reads, debtor's request for voluntary dismissal of case. It continues, the debtors request an order dismissing the case without prejudice. The owner can file for bankruptcy a second time. It can be Chapter 7 or Chapter 13. Let's focus on Chapter 7. Now the owner is in bankruptcy again. The property is now on a stay again. The second automatic stay can only last 30 days. However, it is often extended for cause and owner's change of circumstances. Because of the stay, the creditor can't foreclose. Sooner or later, the case will be closed or dismissed. There will no longer be a stay. Now the creditor can foreclose. The debtor can file a third time. Most likely this will be a Chapter 7. The whole process from beginning to end can last a year. Because of this, in short sales, agents should have a year or longer listing agreement. In the third bankruptcy, there is no stay. The creditor can foreclose. At this point, the homeowner needs to sell or will be foreclosed. Either way, the case will be closed or dismissed. There will be no stay. The creditor can foreclose. The debtor can still file more cases. If that happens, talk to a lawyer. Common misunderstandings. Perhaps the main misunderstanding for a homeowner in foreclosure is the concept of surrendering the property to the bankruptcy. Surrendering a property to the bankruptcy only means that the property is no longer shielded from the creditor. The homeowner still owns the property. Usually the homeowner interprets the surrendering of the property as no longer owning the property. Few attorneys explain this fact to the homeowner. Because of this, the homeowner often vacates the property. This is the reason properties surrendered to Chapter 7 bankruptcy are a good source of leads. Additional bankruptcy issues. Bankruptcy is often used as a delaying tactic. Bankruptcy has plenty of implications. It comes with all kinds of strings attached. Because of this, it is not easy to do. Bankruptcy is an unpleasant solution to a desperate situation. As a consequence, bankruptcies have a high rate of dismissal. Bankruptcies stay on credit reports for up to 10 years. The quality of the bankruptcy service has a large impact on the bankruptcy outcome. Quality of the bankruptcy service. You pay for what you get. Low bankruptcy attorney fees usually indicate minimum service. Minimum service usually leads to harder choices. Bankruptcy case information. All bankruptcy case information is public record and is accessible online. The best way to be up to date with any bankruptcy case is to subscribe to PACER. PACER stands for Public Access Court Electronic Records. This website allows you to access up-to-date records for the majority of bankruptcy cases in the United States. The web address is http://pacer.psc.uscourts.gov. Review. From the short sales point of view, the main bankruptcy issue is the stay. The stay prevents sale of a property. Most people in Chapter 13 want to keep their property, so there is little chance for a transaction. Most people in Chapter 7 have no equity in their property and will have to sell or be foreclosed. For agents, it is important to get a long listing because a bankruptcy can last for up to a year. Bankruptcies are often used as delay tactics by the homeowner. There is a high rate of dismissal. This is where the business opportunities are. Surrendering the property to bankruptcy does not mean no longer owning the property. It means that the property is no longer shielded from creditors. This is a good moment for transactions. Up-to-date individual case information is available through PACER.